Hello everyone, welcome to the 82nd episode of me learning how to trade in Forex. So in the last video we went through how to measure the strength of a breakout. So after a breakout happens, after a consolidation, breakout could happen, and the breakout could either be in a continuation breakout, which is the price going in the same direction before consolidation, or a reversal breakout, which is the price going the opposite direction before consolidation. We learned about how to spot a trend, whether a trend or not seems to be nearing its demise, and a reversible breakout is in order. So we could use the moving average convergence divergence. So when using the moving average convergence divergence, we see that the histogram bars. So if it's getting smaller, it means the momentum is getting slowed down, and then when the histogram bars are higher, it means there's lots of momentum. So there's a trend going on. Yep, and then we could also use the relative strength index. So by looking at the highs and the lows, and then using divergences, so if they do different things, so the price action and the indicator, if they show different things, then there's a divergence going on, because normally the price action and the indicator should be in line with each other. Yeah, yep. So now we are on to how to detect fakeouts. To detect fakeouts. So breakouts are popular among Forex traders. It makes sense, right? When price finally breaks out of that support or resistance level, one would expect the price to keep moving in the same direction as the break. There must have been enough momentum building up in order for price to have broken out of that level, right? It's time to hop on board that train. It's all smooth sailing now. All you have to do is just wait for it. Yes, wait for it. So 10 exponential moving average acting as resistance. So we can see that price keeps hitting it and not being able to break out of it. 10 exponential moving average resistance level broken. So we can see that the price action actually goes above the resistance level. Wait for it just a few more moments to see price inch one direction, then suddenly just move miles in the opposite direction. So breaks, and then what a big drop. Boom. Drops all the way back down. Huh? What the heck? What happened to the bread and butter and the end of the world hunger strategy? End of story. You are left eating ketchup packets and crackers like Tom Hanks in The Terminal. Nominated for the best roller coaster design 2010. Okay. Support and resistance levels are tricky. One thing you should remember to note about support and resistance levels is that they are areas in which a predictable price response can be expected. So support and resistance levels are areas which a predictable price response can be expected. Support levels. Support levels are areas where buying pressure is just enough to overcome selling pressure and halt or reverse the downtrend. So are areas where buying pressure is just enough to overcome selling pressure and halt or reverse the downtrend. A strong support level is more likely to hold up even if the price breaks the support level, and it provides traders a good buying opportunity. So a strong support level is more likely to hold up even if the price breaks the support level and it provides traders a good buying opportunity. Resistance levels are just like support levels but work in the opposite way. They tend to halt or even reverse uptrends. Are areas where selling pressure, right? Yeah, selling pressure well, I keep having to sneeze. Enough to overcome buying pressure and halt or reverse a uptrend. A strong resistance level is more likely to hold up even if the price breaks the resistance level and it provides traders a good selling opportunity. Working the opposite way, they tend to halt or even reverse uptrends. Yep. Resistance levels are areas which selling pressure is just enough to overcome buying pressure and force price back down. Because there's more supply than demand, so the price won't rise and it will drop instead. Yep. Strong resistance levels are more likely to hold up even if the price temporarily breaks the resistance level and it provides traders a good selling opportunity. In the next section, we will dive deeper into fakeouts and discuss why we should trade them and how to profit off them. It's not enough learning about breakout strategies because there will be times that breakouts fail. We have to know what to do in case of fakeouts. This is all part of your Jedi Forex trading. To be a Jedi Master, you must be able to master fakeouts. Are you up for it? Let's go. Fade the breakout. Fade the breakout, you say. Was that just a typo? Did it mean to say trade the breakout? Nope. Fading breakout simply means trading in the opposite direction of the breakout. So, breakout, whoa, where did it go? Means trading in the opposite direction. Fading breakout means trading in the opposite direction of the breakout. Fading breakouts equals trading false breakouts. Breakout, trading false breakouts. So we got the triangle here, resistance, supports, goes up, go down, go up, go down, go down, go down, go up, go down, go up, false breakout because it went back into the went back down through the resistance level again. You would fade a breakout if you believe that a breakout from the support or resistance level is false and unable to keep moving in the same direction. In case in which the support or resistance level is broken is significant, fading breakouts may prove to be smarter than trading the breakout. Keep in mind that fading breakouts is a great short-term strategy. Breakouts tend to fail at the first few attempts but may succeed eventually. Fading breakouts is a short-term strategy, as breakouts tend to fail at the first few attempts, but may succeed eventually. Tend to fail at the first few attempts, but may succeed. May succeed eventually. Repeat, fading breakouts is a great short-term strategy. It is not a great one to use for long-term traders. By learning how to trade false breakouts, also known as fakeouts, you can avoid getting whipsawed. Trading breakouts appeal to many Forex traders. Why? Support and resistance levels are supposed to be price floors and ceilings. If these levels are broken, one would expect for price to continue in the same direction as the breakage. If the support level is broken, that means that the general price movement is downwards and people are more likely to sell than buy. Conversely, if a resistance level is broken, then the crowd believes that the price is more likely to rally even higher and will tend to buy rather than sell. Independent retail Forex traders have greedy mentalities. They believe in trading in the direction of the breakout. They believe in huge gains on huge moves. Catch the big fish, forget the small fries. In a perfect world, this would be true, but the world is not perfect. Frogs and princesses do not live happily ever after. Oof. What does in fact happen is that most breakouts fail. Breakouts fail simply because a smart minority has to make money off the majority. Don't feel so bad. The smart minority tends to be compromised of the big players with huge accounts and buy-sell orders. In order to sell something, there must be a buyer. Oh, so that means all the normal people are the buyers then. However, if everyone wants to buy above a resistance level or sell below a support level, the market maker has to take the other side of the equation. And let us warn you, the market maker ain't no fool. Retail traders like to trade breakouts. The smart minority, the institutional, more seasoned traders prefer to fade breakouts. The smarter Forex traders take advantage of the collective thinking of the crowd or inexperienced traders and win at their expense. Damn, smart. Take advantage of the collective thinking of the crowd or inexperienced traders and win at their expense. This is why trading alongside the more experienced Forex traders could be very profitable as well. Which would you rather be part of, the smart minority that fades breakouts or the losing majority that gets caught in false breakouts? Let's now learn how to fade breakouts. Interesting. How to trade fakeouts. In order to fade breakouts, you need to know where potential fakeouts can occur. Potential fakeouts are usually found at support and resistance levels created through trend lines, chart patterns, or previous daily highs or lows. Usually found at support and resistance levels created through trend lines, chart patterns, or previous highs and lows. Daily. trend lines. In fading breakouts, always remember that there should be a space between the trend line and price. Breakouts. Always remember that there should be space between the trend line and price. There should be space between trend line and price. So trend line, price, space here, no space, space here, no space, no space. Should be space between trend line and price. If there is a gap between the trend line and price, it means the price is heading more in the direction of the trend and away from the trend line. If there is a gap between the trend line and the price, it means that the price is heading more in the direction of the trend and away from the trend line. Like in the example below, having space between the trend line and price allows the price to retrace back towards the trend line, perhaps even breaking it and provide fading opportunities. Alright, so if there is a gap, that means the price is more likely to follow whatever the trend is and not getting closer to the trend line, so there's less chance of it trying to like do a breakthrough or whatever, a breakout. I think that's what it means. There is a gap between the trend line and price. It means the price is heading more in the direction of the trend and away from the trend line. So we can see that the thing hits the trend line, so there's a chance of fading. Long wick shows selling pressure, no follow through though. So these are fake outs basically, because it does break through the resistance line, but then it never actually, kept going. It just came back down again. Right, okay. The speed of price movement is also very important. If the price is inching like a caterpillar towards the trend line, a false breakout may be likely. Right, okay, so price is inching towards the trend line, a false breakout may be likely. However, a fast price movement towards the trend line could prove to be a successful breakout. A fast price movement towards trend line could prove to be a successful breakout. With a high price movement speed, momentum can carry prices past the trend line and beyond. In this situation, it is better to step back from fading the breakout. It's better to not fade this particular breakout. Very bullish candle, so very strong momentum, and then it just kept going upwards. So this is like a proper breakout. How do we fade trend line breaks? It's very simple actually. Just enter when the price pops back inside. This will allow you to take the safe route and avoid jumping the gun. You don't want to sell above or below a trend line only to find out later that a breakout was real. Using the first chart example, let's point out possible entry points by zooming in a little. So sell here, right? Sell. Enter when the price pops back inside. So price broke through but then went back inside, so you enter here. You would sell here, wouldn't you? Because it's good selling opportunity. Yeah, you sell here because it's a resistance level. Trade fakeouts. Enter the trade when price pops back inside the resistance level or above the support level. So yep, chart patterns. Chart patterns are physical groupings of the price you can actually see with your own eyes. They are an important part of technical analysis and also help you in your decision-making process. Two common patterns where false breakouts tend to occur are head and shoulders, double top and bottom. Two chart patterns where false breakouts tend to occur. Head and shoulders, double tops and bottoms, head, double top and bottom. The head and shoulders chart pattern is actually one of the hardest patterns for new traders to spot. However, with time and experience, this pattern can become an instrumental part of your trading arsenal. The head and shoulders pattern is considered a reversal. It is formed at the end of an uptrend. It could signal a bearish reversal. Conversely, if it's formed at the end of a downtrend, it could signal a bullish reversal. Head and shoulders are known for generating fakeouts, false breakouts, and creating perfect opportunities for fading breakouts. False breakouts are common with this pattern because many traders who have noticed this formation usually put their stop loss very near the neckline. So we've got the head and shoulders here. So we've got 1, 2, 3, the 3 peaks. This one here. Left shoulder, right shoulder, head. So this is formed at the end of the downtrend. So if it's formed at the end of the downtrend, it could signal bullish reversal. So it could signal that the price is going to go upwards. Therefore, this is the neckline here. We place our entry order just a bit above the neckline, and then our stop loss order just a little bit below the neckline, and hopefully our price is going to shoot up like that. And if it doesn't, then it just closes the trade instantly to avoid big losses, I guess. Consider the reversal. Shoulders is considered a reversal. If head and shoulders formed at the end of and uptrend. It could signal a bearish reversal if head and shoulders formed at the end of a downtrend. It could signal a bullish reversal. Head and shoulders are known for generating fake outs and creating perfect opportunities for fading breakouts. False breakouts are common with this pattern because many traders who have noticed this pattern usually put their stop loss very near the neckline. Wait, why does that make false breakouts common? When the pattern experiences false breakout, price will usually rebound. Traders who have sold a downside breakout or who have bought the upside breakout will have their stops triggered when price moves against their position. This is usually caused by institutional traders who want to scrape money from the hands of individual traders. All your pips belong to us. Sold a downside breakout, we've bought the upside breakout. In a head and shoulders pattern, you can assume that the first break tends to be false. You can fade the breakout of a limit order back on the neckline and just put your stop above the high of the fake out candle. Wait. So when the pattern experiences a false breakout, prices usually rebound. Usual stop loss, if the price went down, the thing would stop. Trade would end. You can fade the breakout of a limit order back in the neckline and just put your stop high above the high of the fake out candle. Back in the neckline. And just put your high above the fake out candle. What does that mean? Put a limit order back in the neckline. Back in the neckline. And just put your stop above the high of the fake out candle. What? In a head and shoulders pattern, can assume that the first break tends to be false. If a limit order back in the neckline and just put your stop above the high of the fake out candle. You could place your target a little lower, a little below the high of the second shoulder or a little above the low of the second shoulder of the inverse pattern. Limit order. Wait, I need to find out what limit order means. Limits a certain amount of profit. So it is the take profit limit. But what's your target? I thought that was your profit limit. Target. Yeah, isn't profit target the same as a limit? Yeah, this bit's a little... I don't really understand what it's trying to say here. You could place your target a little below the high of the second shoulder. Below the high of the second shoulder, so somewhere around here or something. Or a little above the low of the second shoulder of the inverse pattern. Yeah, I have no idea what this thing is trying to say, to be honest. Just could fade the breakout with a limit order back in the neckline. Put the stop above the high of the fake out candle. Right, okay. The next pattern is a double top or double bottom. Traders just love these patterns. Why do you ask? Well, it's because they're easiest to spot. When the price breaks below the neckline, it signals a possible trend reversal. Because of this, plenty of traders place their entry orders very near the neckline in case of a reversal. The problem with these chart patterns is that countless traders know them and place their orders at similar positions. This leaves the institutional traders open to scrape money from the commoners' hands. All your pips belong to us again, wahahaha. So instead of breaking downwards, it goes up. Similar to the head and shoulders pattern, you can place your order once the price goes back in to catch the bounce. You can set your stops just beyond the fake out candle, so like somewhere around here. Wait, before double top, double bottom. So what usually happens at double top is it usually goes down, similar to, so goes like, so it should go like that, but then it went like that instead. Right, okay. Double tops slash bottom. Let's just write to trade a false breakout, place the order once price goes back in, so in this case once the price goes back above the neckline, to catch the bounce. Can set the stops just beyond the fake out candle. Right, what don't really know what to say, to be honest. Can set the tops just beyond the fake out candle. Place your order once the price goes back. So place your order around here and set your stop around here. Right? So place your buy order and then it does that. Okay. What kind of market should I fade breakouts? The best results tend to occur in a range-bound market. However, you cannot ignore market sentiment, major news events, common sense, and other types of market analysis. Best market to fade breakouts is a range-bound market. However, don't ignore market sentiment, major news events, common sense, and other types of market analyses. Financial markets spend a lot of time bouncing back and forth between a range of prices and do not deviate much from these highs and lows. Ranges are bound by support level and resistance level, and buyers and sellers continually push prices up and down within these levels. Fading the breakout in these range-bound environments can prove to be very profitable. However, at some point, one side is eventually going to take over and a new trending stage will form. Right, summary. Trading breakouts and fakeouts. Trading breakouts. With breakout trades, the goal is to enter a market right when the price makes a breakout and then continue to ride the trade until volatility dies down. So for breakout trades, enter the market right when the price makes a breakout and then continue to ride the trade until volatility dies down. Breakouts are significant because they indicate a change in the supply and demand of the currency pair you're trading. Okay, a change in the supply and demand of the currency pair being traded. You'll notice that unlike trading stocks or futures, there is no way for you to see the volume of trades made in Forex. Because of this, we need to rely on volatility. Volatility measures the overall price fluctuations over a certain time, and this information can be used to detect potential breakouts. So volatility measures the overall price fluctuations over a certain time and can be used to detect breakouts, potential breakouts. Chart indicators to measure volatility. There are a few indicators that can help you gauge a pair's current volatility. Using these indicators can help you tremendously when looking for reversal for breakout opportunities. 3 indicators to measure volatility: moving averages, Bollinger Bands, and average true range. There are two types of breakouts: continuation, reversal. Whoops. How to spot breakouts. To spot breakouts, you can look at chart patterns, trend lines, channels, triangles. The spot breakouts can look at chart patterns, trend lines, channels, and triangles. How to measure breakout strength. You can measure the strength of a breakout using the following. Breakout strength can be measured using moving average, convergence, divergence, and relative strength index. Finally, breakouts usually work best and for real with some kind of economic event or news catalyst. Breakouts usually work best and for real with some kind of economic event or news catalyst. Always be sure to check the economic calendar for upcoming news before figuring out whether or not a breakout trade is the right play for the situation. Trading breakouts and fakeouts are great strategies to add to your trader's toolbox. Trading fakeouts. Institutional traders like to fade breakouts, so we must like to fade breakout also. Are you going to follow the crowd or are you going to follow the money? Oh. Think, act, eat, sleep, and watch the same movies that these guys do. If we can trade in the same way the institutional players do, success is just a glimpse away. A fading breakout simply means trading in the opposite direction as the breakout. Trading in the opposite direction of the breakout. You would fade a breakout if you believe that a breakout from a support or resistance level is false and unable to keep moving in the same direction. Breakout when if you believe that a breakout from the support or resistance level is false and unable to keep moving in the same direction. In cases in which the support or resistance level broken is significant, fading breakouts may prove to be smarter than trading the breakout. Potential fakeouts are usually found at the support and resistance levels created through trend lines, chart patterns, or previous daily highs or lows. Fakeouts are usually found at support and resistance levels created through trend lines, chart patterns, or previous daily highs and lows. The best results tend to occur in a range-bound market. Best results tend to occur in a range-bound market. However, you cannot ignore market sentiment, common sense, and other types of market analysis. However, don't ignore market analysis. Financial markets spend a lot of time bouncing back and forth between a range of prices and do not deviate much from these highs and lows. Finally, the odds of a fakeout are higher when there is no major economic events or news catalyst to shift traders' sentiment in the direction of the break. Fakeouts chances of fakeouts appearing are higher when there is no major news to shift traders' sentiment in the direction of the break. Okay, quiz time. Trading breakouts and fakeouts. Breakouts are one of the most used sharp signals used by market technicians everywhere. Do you have the knowledge to know whether it's a real deal or fake out? Which of the following is not a good measure of volatility? It's not a good measure of Fibonacci tools. How do you fade trendline breaks? Jump in when price pops back inside. When average true range is falling, volatility is decreasing. True or false? Volatility is on the rise when Bollinger Bands contract. False. What occurs when price starts to trade outside a recent consolidation or trading range? Breakout? A something breakout is a reversal of price action after breaking consolidation. A reversal. Something are generally bullish patterns that signal a breakout to the upside. Ascending triangles. Which of the following is a good tool to confirm a breakout? KFC. Relative Strength Index. Why do false breakouts occur with the head and shoulders pattern? Traders usually put their stop loss close to their neckline. Fading breakouts get better results in which type of market? Range bound. Supermarket, I saw. Why do breakouts fail? A small minority with bigger position sizes is making money off the majority. If MACD begins to decrease even when the trend is continuing, there's a good chance that momentum is also decreasing and trend could reverse. Yep. Which strategy tends to work well when trading breakouts? Jump in when volatility is high? How do you fade a breakout? Take the opposite direction of the breakout. Where do potential fakeouts usually found? At support resistance levels. What occurs when price breaks an important level but doesn't continue moving in the same direction? False breakout. As a symmetrical triangle suggests a breakout in which direction? Either direction, aka bearish. What was question 13? Oh right, I think it's the volatility. Rather than for look for currency pairs with a volatility that is low. Right, low volatility, not high volatility. Okay, I remember now. Yep. Okay. Fundamental analysis, which is going to be in the next video. So yeah, we finished up all the trading breakouts and fakeouts, which is very good. In the next video, we're going to start with what is fundamental analysis. So thank you all for watching this video, and I will see you in the next one. Peace.